Look at Intel right now. Like, if you are holding the stock today, you are probably staring at your screen, just watching this massive 85% year-to-date surge, and honestly, sweating.
Oh, absolutely. You're trying to figure out your next move.
Right. You are wondering, do I take my profits and run, or am I jumping off the rocket ship right before it actually leaves the
Yeah,
atmosphere?
that's the ultimate dilemma right now.
I mean, is this the greatest corporate comeback in a quarter century, or is it just a massive value trap waiting to spring on unsuspecting retail traders?
I would actually take that a step further, honestly. It is a masterclass in market psychology.
Oh, for sure.
You look at the stock chart, right, and it is screaming that Intel is the future of global technology. But then you open up the actual balance sheet, and it looks like a company fighting for its life.
Yeah, the math is not matching the hype.
Exactly. We have a fundamental disconnect between the story being told out there and the actual math being reported.
So let's set the stage now. Today is April 20, 2026. Intel, ticker symbol INTC, is sitting at $68.50.
High stakes.
Very high. And our mission in this deep dive is to completely tear apart Intel's financials, the underlying technicals, and, well, some bizarre insider activity.
We really need to figure out what is driving this run.
Because something has to give, right? And just a quick reminder as we get into this, this is an intellectual debate of the data. We are exploring the mechanics of the market, but this is absolutely not financial advice.
Definitely not. We're just looking at the numbers.
Yeah. And hey, if you want more deep dives like this, you know what to do. Like the video, subscribe to our YouTube channel, and you must leave us your feedback in the comments. We want to hear from you.
Because we really need to figure out if the market is just, completely detached from reality here.
Yeah.
Or if it is finally pricing in a historic structural turnaround that the balance sheet just hasn't quite caught up to yet.
Right. We have to unpack this narrative versus the financial reality because the journey this stock has been on over the last 52 weeks is just wild.
It really is unprecedented.
We are talking about a painful 52-week low of $18.25. Let that sink in. Less than $20 a share.
Unbelievable.
And then recently it hit a high of $70.33. That is an absolute wealth generation machine for anyone who bought the bottom.
Yeah, if you timed it right.
Exactly. And there are three specific massive stories fueling this hype train right now.
Well, the market runs on forward-looking narratives, right? And Intel has managed to converge three of the biggest technological shifts of the decade into like one cohesive pitch.
So let's break those down. First, you have the successful launch of the 18A process node. Second, the enormous $8.5 billion injection from the U.S. GPS Act.
Huge catalyst there.
Right. And third, the wild card everyone is talking about, the Terafab strategic partnership involving Elon Musk's ventures.
That's the one making all the headlines.
It sounds incredible, but let's look under the hood a bit. Starting with 18A, why does this matter so much? Because for years, Intel was kind of the butt of the joke in the semiconductor world for constantly delaying their chips.
Yeah, to understand why 18A is really driving the stock price, you have to understand the physics and the economics of the semiconductor industry.
Okay, lay it out for us.
So for the last decade, Taiwan Semiconductor, TSMC, essentially ate Intel's lunch. They could shrink transistors smaller and faster than Intel could.
Right, and smaller is better.
Exactly. When you shrink a transistor down to the atomic level, which, by the way, is what the A in 18A stands for, angstroms, you pack more computing power into a smaller space.
Making it way more efficient.
Right. This means the chip uses significantly less power and generates less heat. And in the era of these massive AI data centers, power and heat are the two biggest bottlenecks.
Oh, that makes total sense.
So the successful launch of 18A signals to the market that Intel hasn't just, caught up to TSMC. They're attempting to leapfrog them.
Wow. Okay, so it restores their technical pride, and then you add that $8.5 billion from the CHPS Act.
Right, which is not just free money.
No, it's the U.S. government declaring that Intel is basically a critical asset for national security. They want a domestic supply chain so they aren't reliant on overseas foundries.
Exactly, and that naturally leads to the Terafab partnership with Musk.
Which is the true catalyst here, right?
Oh, absolutely. Musk's ventures, whether it's autonomous driving, XAI, robotics, they require a virtually infinite supply of custom compute power.
And TSMC is already booked solid.
Right, their manufacturing lines are completely bottlenecked. So the Terafab project is essentially Intel offering to build a bespoke, massive-scale mega factory specifically to crank out silicon for these future technologies.
I love this, but let's connect this back to reality for a second. Think of NVIDIA and AMD as master chefs who design these incredible recipes for AI chips.
Yeah, I like this analogy.
But they don't actually own a kitchen. They rent TSMC's kitchen. Intel is trying to build the biggest, most technologically advanced kitchen in the world with this Terafab project, hoping all those master chefs, including Musk, will be forced to cook there.
That is a great way to put it.
But, building kitchens is ridiculously expensive. So let's look at the actual income statement because the contrast is jarring.
It is a brutal reality check, honestly. Let's look at the quarterly annualizations. Q4 2025 revenue came in at $13.67 billion.
Which sounds huge.
Right. In a vacuum, that actually beat Wall Street estimates, which usually triggers a stock rally.
Right.
But that revenue actually represents a 4.1% year-over-year decline.
Wow. So the top line is actually shrinking.
Yes.
And what about the bottom line? Earnings per share came in at 15 cents, which, yeah, it crushed the 4-cent estimate. But when I look at the actual net income for that same quarter, it was negative $591 million.
Yeah, that's a tough pill to swallow.
They bled over $500 million in 3 months.
And this is where the volatility of their current transition becomes super obvious. Just a period prior, they posted $4.06 billion in positive net income,
That is a massive swing.
swinging from a $4 billion profit to a $500 million loss shows the incredible financial strain of transforming their entire business model.
And the forward guidance isn't exactly a relief either, right?
No, it's not. Next quarter's EPS estimate is essentially flatlining at one single penny. The profit engine is completely stalled out.
And honestly, it gets scarier when you look at the cash flow statement. Free cash flow is deeply negative.
Because of the construction.
Exactly. They're pouring over $18 billion into capital expenditures just to physically build these new foundries. So let's look at the balance sheet. They have a debt-to-equity ratio of around 40.76%. And their EBITDA is sitting at $11.95 billion. Now, EBITDA is basically the cash a company generates from its core operations before the tax man and creditors take their cut. But with an $18 billion construction bill, is $11 billion in core earnings actually enough? I mean, can they survive this construction phase without going bankrupt?
Well, they aren't going bankrupt tomorrow. A 40% debt-to-equity ratio is actually pretty manageable for a legacy titan like Intel.
Okay.
They have incredible historic lines of credit and an EBITDA margin still hovering near 25%. The issue isn't immediate insolvency.
Then what is it?
It is structural resilience over time. That negative free cash flow means they are funding this mega kitchen with borrowed time and borrowed money. They are racing against the clock.
So they need it to pay off and fast.
Exactly. They need the 18A nodes and the Terafab partnership to start generating massive cash before the interest on that debt becomes an anchor they just can't lift.
Okay, so we have a company bleeding $500 million a quarter, burning through free cash flow, yet the stock is up 85%.
It's wild.
That makes zero logical sense on a spreadsheet. So if the fundamentals aren't driving this price up, who is actually pressing the buy button?
Right, which brings us to the technical analysis.
Yes, let's dive into the charts.
The technical chart is telling a story of relentless consensus. From a momentum perspective, the buyers have been in total control.
So strong short-term strength.
Very strong. The stock at $68.50 is sitting comfortably above its 50-day moving average of $64.52. And it is light years above its 200-day moving average, which is way down at $51.04.
And for those following the charts, being that far above a 200-day moving average usually signals that the long-term trend has completely inverted from bearish to bullish.
Correct. Now, if we look at the immediate battlefield, we see that short-term strength, but there are looming psychological barriers.
Let's talk support and resistance.
Sure. Immediate support. So the floor, where buyers historically step in, is resting at $67.38.
Okay, what if the narrative cracks?
If it cracks, there is a much deeper historical floor down around $55. On the flip side, the immediate resistance is that recent 52-week high of $70.33.
So that's the ceiling right now.
That is the ceiling. If they break through 70.33, technical models show the next major pivot levels at 71.44 and 72.56.
So the ceiling is right there, just a couple of bucks away. But I always see these indicators thrown around, like the MACD and the RSI. What are they actually measuring underneath the hood here?
Good question. Let's start with the EMA-D, the moving average convergence divergence. It is currently sitting at 1.330, flashing a confirmed buy signal.
Okay, simple enough.
Think of the MCD as a measure of acceleration. It compares a stock's short-term price momentum to its long-term momentum. When the short-term average pulls sharply above the long-term average, it indicates that buying pressure is actively accelerating.
But acceleration can't last forever, right? Which brings us to the RSI, the Relative Strength Index. It's hovering around 64.5.
Right. The RSI measures the speed and change of price movements on a scale of 0 to 100. An RSI of 64.5 indicates very strong upward momentum.
But there's a catch.
There is. It is knocking on the door of the 70 level. Anything over 70 is widely considered overbought.
Meaning?
That means the buying pressure has pushed the price up so fast that a pullback is statistically likely just to let the asset digest the gains.
Okay, here's where it gets really interesting and, frankly, a bit of a mystery. I was digging into the order flow data to see who is actually making these trades.
Oh, the order flow is fascinating right now.
There is a glaring contradiction. Everyday retail traders are actively taking profits right near the $70 resistance level. They wrote it up from the 20s, and they are hitting the sell button.
Cashing out.
Right. But the institutional order flow shows that the smart money, the massive hedge funds and asset managers, they have been accumulating heavily since early April.
Yeah, they are
Buying, are you telling me the institutions are buying the absolute top? Like, do they know something retail doesn't?
That divergence is the multi-billion-dollar question, honestly. Historically, retail traders are the ones buying the top out of FOMO, fear of missing out, while institutions quietly distribute and sell their shares to them.
But here, it is completely inverted.
Exactly. The key difference is time horizon and execution strategy. Retail traders see a stock go from 18 to 68, hit a psychological resistance level of 70, and decide to lock in their gains.
Which is a perfectly rational human reaction.
Highly rational. But institutions don't trade on human emotion. They trade on multi-year probability models.
So they don't see this as the top.
No, they aren't buying the top in their view. They are looking at the geopolitical reality of the Shia-Chips Act and the sheer scale of the Terafab partnership. To an asset manager projecting out to 2030, if Intel regains global foundry dominance, 68 isn't a ceiling.
It's the new floor.
It is the new floor. Furthermore, institutions use dark pools and algorithmic buying to scale into positions slowly. They are absorbing the shares that retail is selling because they need massive volume to build their positions without, spiking the price to 80 overnight.
But wait, not everyone on Wall Street agrees with those asset managers? Which leads us to this massive valuation debate.
Right. Undervalued versus value trap.
Exactly. Is Intel truly undervalued right now because of this future potential, or is this the ultimate value trap? Because when I look at the analyst ratings, it is a bloodbath of pessimism.
The professional analyst community is overwhelmingly skeptical right now. Out of 41 to 44 major analysts covering Intel, the consensus is squarely neutral to hold.
That's pretty telling.
We're looking at 32 hold ratings, 9 buys, and 6 outright sells.
And the price targets are even worse. The average price target from these analysts is $52.26.
Which is way below where we are.
We are currently trading at $68.50. That implies a staggering 23.7% downside risk from where we are right now.
Even the upgrades aren't great.
Right. Even the analysts who are upgrading the stock, like Bernstein recently raising their target, they only bumped it up to $60. That is still an $8 drop from current levels.
And if you look at the algorithmic intrinsic valuation models, they paint an even starker picture.
Oh, really?
Yeah. If you look at platforms that calculate a company's true worth based on forward price-to-earnings ratios and current cash flows, they conclude that Intel is roughly 61% overvalued.
Wow.
They peg the actual intrinsic value of the company closer to $26.58.
$26.58. So wait, let me stop you there. If the intrinsic value is $26, why aren't the hedge funds shorting the stock back to the Stone Age?
Because shorting a government-backed turnaround story with incredible momentum is financial suicide.
Don't fight the trend.
Exactly. The narrative is simply too strong right now. The market can remain irrational much longer than a short seller can remain solvent.
Okay, so we have to look at the people who actually run the company to see what they believe. And insider activity over the last 90 days shows net selling of about $1.71 million.
Taking some chips off the table.
Literally. Executive Vice President April Miller Boise sold over 36,000 shares back in February at a split-adjusted price of $78.71. She took a massive payday right on a momentum spike.
We have to view that in context, though. I mean, executives sell for many reasons: taxes, diversification, maybe buying a house. But what was highly telling is the buying behavior.
Right, the CEO.
Throughout the darkest days of 2024 and 2025, when the stock was just languishing in the $19 to $31 range, CEO Pat Gelsinger was a consistent, heavy buyer.
He bought the blood in the streets of his own company.
He backed his own turnaround strategy with his own wealth when the rest of the market had completely written Intel off.
But the setup today is different.
Very different. The combination of factors we are looking at today, the negative free cash flow, the 23% downside analyst targets, the executives taking profits on the rips, it creates the perfect storm for a classic value trap.
Okay, so I am struggling to wrap my head around this value trap idea in this context. Usually a trap is when a stock looks incredibly cheap, right? So you buy it and then it goes to zero. But Intel is up 85%. How do you get trapped in a stock that's already skyrocketing?
It is the Wile E. Coyote running off a cliff dynamic.
Okay, explain that.
The trap springs when the narrative outpaces the fundamentals so wildly that the stock is essentially running on thin air. A retail investor sees the 85% run, reads a headline about Elon Musk and Terafab, and buys in at 68, assuming it's going to 100.
Right, FOMO kicks in.
Exactly. But the company is still bleeding $500 million a quarter. When the market inevitably demands to see actual profits to justify that $68 price tag, and the company can't produce them, the sentiment breaks.
And then the floor falls out.
The price violently corrects to the mean, down to that $52 analyst target, or even lower. The executives who bought at 20 are perfectly fine, but the late-arriving retail investors hold the bag.
Ouch. All right, let's lay out the ultimate bull versus bear case here to see both sides of that clash. I'll take the bull case because the narrative is undeniably powerful.
Go for it.
First, the 18A node actually works. That fundamentally resets their technological standing. Second, the geopolitical reality. The U.S. government just cannot afford to let Intel fail if it wants to secure its military and domestic supply chains against global instability.
That's a massive safety net.
Exactly. And third, if Terafab actually succeeds, they don't just compete with TSMC, they offer a secure, high-yield alternative for the biggest tech companies on Earth.
Now, the bear case, however, is grounded in harsh, immediate reality.
Bring us back down to Earth.
First, the stock has moved too far, too fast, based purely on promises, not profits. Second, that $18 billion capex is going to act like an anvil on their margins for years.
Yeah.
Building factories simply destroys cash flow.
Oh, getting around that.
And third, despite all this massive effort, Intel still deeply lags behind AMD and NVIDIA in high-end AI chip design. The bears argue that Intel is spending a fortune just to avoid irrelevance, not to actually dominate the future.
Okay, so it all comes down to execution. Let's talk timelines. If you are tracking this stock, what are the predictive models showing for the short, medium, and long term?
Well, in the short term, the next few weeks, the technical models suggest a period of consolidation. Expect a very tight trading window between $68.68 and $69.93.
Sideways action.
Yeah, the market is basically holding its breath, waiting for a catalyst to break that $70 resistance.
And if we zoom out to the medium term, like looking toward the end of 2026.
Extreme volatility. If the Terafab hype does not quickly translate into measurable margin improvements on the income statement, the downside risk is severe.
How severe?
Predictive models show a potential nasty correction all the way back down to $37.35 by year-end.
Wow. From 68 down to 37. That is the value trap springing shut. Half your